Good day. Welcome to this What's Up with the Markets session. We're going to go through the market status and have a look at some charts to do with the indices. And also today I should let you know up front that there was a request to have a look at the relative relationship between gold and Bitcoin. So that's one of the things to look forward to today. And we'll go through some other analyses as well. The ones that are not that important or not showing anything that's meaningful, I'll just skip through those just to make the session a bit quicker. So before we do that, I've got to tell you that everything we cover here today is of a general investment advice nature, and there's no personal advice that's being provided here, and that past performance is not a reliable indicator of future performance. Okay, let's move across to Beyond Charts to have a look at where we always start with the Dow Jones. Big day on the US markets. The Dow Jones, you can see an entry signal there, that green arrow, and a clear breakout above this downward channel, the black channel, and down here on the relative strength versus the S&P 500, this starting to underperform. So when you have the Dow outperforming the S&P 500, it's typically a bit of a negative sign for equities. And now we're starting to see the dip happen here where the S&P 500 is starting to outperform the Dow Jones, and also a clear breakout here above this resistance zone that I've had in there for some time. It goes back, it started all the way back here in what date was that? Back in April 2021. So 2.5 year resistance zone. Quite clear, lots of touch points. The Fibonacci found support just below the 38.2%. And the last time we met on the 1st of November was round about here. And the message of the day then was that we were hanging on by the skin of our teeth. And we certainly were, because all of these support levels were in. And if we had fallen below those support levels and buyers didn't come in to the market and outpower the sellers, then certainly there may have been a bit more blood on the streets. However, the market is reversed. The low is in. These we've got a higher high here has been formed, and now these other highs over here are in the sights of the Dow Jones. So this is a significant breakout. There's a breakaway gap. There's resistance zones being broken through. There are downward channels that we've broken out above. And so this truly is and I think there are a lot of short sellers, which is really what would have formed the gap on the indices, have been covering their positions. They wouldn't have all covered their positions. You don't not 100% of the short sellers and the bears would have a positive, would have switched to a positive view. And of course, there are different time frames as well that people are shorting the market and may still have some conviction, in which case if this market continues to rise, those covers are going to continue to come in over the next few days, which is what causes these V bounces, these V bottoms that occur. So onto the S&P 500, we'll just zoom out a bit over here. The dotted black resistance zone at the very top, there's the all-time high. So certainly within its sights here, it's not that far off, but certainly a new high has been made. That previous peak over there has been taken out. These over here, these in the short term, are in the sights of the S&P 500, and then this peak over here where there is resistance. So the next target is this resistance zone, which the peak was at 4607. We're sitting at 4495, so only about 120 odd points away, 110 odd points away. So pretty close on the S&P 500. The downward channel broken out of, and certainly an entry signal occurred a couple of days on the index using our medium to longer term methodology, mechanical methodology. And you can also see that volatility has dropped a little bit over here as well, although there was a pickup, which is unusual to see when you see an up day combined with a little bit of an increase in volatility. That's pretty serious. So the breakout, that's the theme, is there's a clear breakout, a breakout bar on the major indices. Let's keep on going to see if we get any insights from some of the breadth of market indicators. Here we're looking at the cumulative new high, new low. Obviously the blue line is the index. The gray line is the indicator, the new high, new low. Nothing much to report there. And it is, just a few days is not enough for these indicators to move, needs a bit longer. And we are looking at shorter to medium term trends here, not just a few days. A little bit of a break up here in the advanced decline line, index rising, and a little bit of a rise here in the advanced decline line. And that, you might say, in the short term, a little bit of a break above that downward trend, of the trend line. But we're looking for this kind of movement over here, which builds up over a month or so. So let's see how these indicators, these breadth of market indicators, respond. The number of stocks that are above their 150-day moving average, simple moving average, not quite got to the 50% yet, but there's the clear breakout on just that trend line. So certainly a bounce off the bottom over here, where we only had 20% of the S&P 500 stocks outperforming their simple 150-day moving average, but now getting up to the 50% mark and rising, but still not all in. Right, this is the US dollar index, one that I've been emphasizing quite a bit. And remember, we did say that the US dollar index needed to fall for equities to rise. And of course, I was showing you a different chart over previous weeks, previous sessions. But last session introduced this one, which is a base 100 or a base reference to the CRB index, which is commodities. And there is, I did make the comment at the time that there is a major or very close negative correlation to the CRB index between the US dollar, and effectively all of these black and red is wherever the US dollar rises, CRB index falls, commodities fall, and vice versa. When US dollar rises, commodities fall. And what we're seeing here is a big down bar in the US dollar, the dollar index that is. And these green ellipses over here are the few times, there's not many of them, 1, 2, 3, 4 that I've got in here, where they've actually moved in the same direction. Otherwise, they move in opposite directions. So if the CRB index is rising, the US dollar is falling, all of this is lining up for a risk-on environment in equities. This here is the Russell 100 growth versus the Russell 1000 growth versus the Russell 1000 value index. And you can see this entire time, even though there was a bit of a dip at the end over here zoom in a bit, there was a dip here, obviously in line with the market and the growth index. There was also a dip in the value index, but this relative strength line and this smoothing indicator, the SIROC that I've got on this relative strength line, so it's an indicator of an indicator. The relative strength has shown that the Russell 1000 growth has continued to outperform value during this what have we got, about a 3 or 4 months, 3 months downturn, 3.5 months downturn that we've had in the equity markets. So what we're seeing here is the Fibonacci retracements, the retracement we've had, the length of it, the depth of it, and everything is right in line with a pullback, given the run up that we had from October, November last year in indices, in the US indices. So this growth versus value it's a risk on, and it's been in that risk on the entire period of time. And it's now certainly confirming what's going on. Right, the consumer discretionary, a sentiment indicator versus consumer discretionary versus consumer staple. We've had that as a risk on here. I've got the relative strength has shown that discretionary has outperformed staple this entire period of weakness we've had here. And now the discretionary sector has given an entry signal as well, in a clear breakout over here, and we can see that aligns down here with the S&P 500 breakout. So these sentiment indicators, breadth of market indicators, not quite in yet, but certainly the sentiment indicators are confirming what we're seeing in the equity markets. This here is the put call ratio. I'll just zoom in a bit. It's a bit of a squiggly line. I've got a line chart on there, but what we had here, this green line I've got here, I've basically lined it up with this indicator. So what I've done is I've got a smooth trend indicator on a 250-day moving average of the put call ratio. And effectively what that's trying to do is gauge with a medium-term horizon what's the upper hand, who's got the upper hand between buying of puts and buying of calls. And I know it's very early, but this green line over here, where the SIROC indicator, the smoothing indicator, the smoothing trending indicator dipped below the 90 zone, which is a sell signal on buying puts, which effectively calls are now in favor. And but it's very early days, and we do need to see a bit more confirmation through this. But that is if you're trading this mechanically, you would have had a buy signal formed over here on the put call ratio, more calls in than puts. And it's a 250-day moving average, so it needs a bit more time, so very early days, but it is still a green shoot sign that's supporting the risk on environment here. This is bonds. So bonds hit 10-year treasuries. Yields hit 5% just up over here at the beginning, at the end of October, 20th of October, 23rd of October. And now we're seeing the dip in yields here. So there's the dip in yields. So now there's buying of bonds, which is pushing the yield down on 10-year treasuries. And we've had that clear breakout, and I've got a medium to longer term indicator on here. So we haven't seen that dip yet. What we'll look for in coming weeks, coming sessions, is this indicator, this trending indicator with a medium to term horizon, let's say a 3 to 4 month horizon, falling below that blue zone. When that happens, we'll have a situation like we had over here. And that means that the relationship between bonds and equities will be positive for equities. So we haven't had that yet. The fear index, the VIX index, is certainly heading down, and right near the bottom of this wide channel that we've got here, indicating that fear index is down as well, which is positive for equities. Right, onto the Nasdaq. I'll just zoom in here. Clear breakout on the Nasdaq. We had an entry signal earlier. 3rd of November was the entry signal here. Breakout on this down channel, and certainly approaching some resistance, overhead resistance here. Fell below this channel, which I've had on since COVID, I think, since the no, not since COVID. This is the long ones since the last year. So this is a year-long upward channel. We fell out the bottom over here. Didn't move that lower channel line to see what happened. We got to the 50% retracement here on the Fibonacci, which you tend to expect to see a bit more of a percentage-wise, relative-wise retracement on the Nasdaq than what you would see on the S&P 500, and we certainly had that. Didn't quite get to 50%, but a bit more of a lower retracement than the S&P 500. A steeper V bottom here, and this risk on that we've had, which has got a medium to longer term outlook, which is basically the medium term trending indicator on this relative strength line between the Nasdaq and the S&P 500. So if the Nasdaq is outperforming the S&P 500, then that's a risk on environment. So just to take some of the noise out of the relative strength ratio between the two indices, I put the smooth trending indicator on here, and it never gave a sell signal. So it's come through. Now, certainly, if you're using that as the only signal, which you should not do, you would have to have sat through drawdown in your portfolios. But we're taking the view here of looking at a number of indicators over similar time periods to see which ones are still maintaining a bullish outlook and which ones are maintaining a bearish. And I'm not trying to do a weight of evidence here at all, but it's just an indication of different ways of looking at the market through raw price action, sentiment, and breadth of market. Now, I've just got to say at this stage that, having come to the third US index and all the breakouts are happening, is that I don't use any of this to make my day-to-day, week-to-week decisions with my own money or with the public real money portfolios that I trade, for everybody to watch. That is purely 100% mechanical, based on price action of the universal stocks that we look at. And over this period of time here that we've had this negative sentiment coming down, which effectively started back in July, I haven't been below 50% invested in any of my portfolios. Sure, I've worn some drawdown, but because I continue to get entry signals in certain stocks when the signals occurred, it's in 100% mechanical, no questions asked, and have been 100% invested from a day or two from the bottom of this dip. So, of course, did I know it was going to happen? I had no idea it was going to happen, nor do I need to know what's going to happen, because I have an edge. And the edge is what I follow, because the edge is what keeps me in my flow with the market in the time frame that I trade, in the direction that I trade, which is long, medium-term swing trading. Okay, so the Nasdaq has had its breakout, confirming the others. It's a big breakout, and this is a cumulative. This is a new high, new low on the Nasdaq. We still haven't seen a turn over here, so there are still, and this data would be a day out of date on the cumulative indicator. We haven't seen a turn up yet, so there are still more 52-week lows being made than 52-week highs on the wider Nasdaq index. Looking at the cumulative advanced decline, this is on the Nasdaq 100. You can see that the advance, this is the gray line, is pretty much moves in sync with the index. It's a narrow universe of stocks, just being the Nasdaq 100, and certainly rising. So more stocks rising than falling in the Nasdaq 100 and in line with the indicator. So no divergence there is what we're looking for when we look at the advanced decline and new high, new low indicators. This is the Nasdaq on the 150-day moving average. How many stocks above the 150-day moving average? There are more that are above in the Nasdaq than what there are in the S&P 500. So a little bit of an indication that there's a bit more of a focus on stocks in the Nasdaq at the moment, which is what happens when you get into risk-on type environments. And here's the clear breakout on the Nasdaq 100 index, aligning with that breadth of market indicator. Right, the semiconductor industry ETF, this medium-term indicator is trending indicator is still heading down, but we've had a clear breakout out of the channel here, and we'd like to see this indicator, which it will do, because what I've got here, it's a relative strength between the semiconductor sector or industry group and the Nasdaq. So they have a lot more closer. You can see that the relative strength line here doesn't have that much volatility in it. There's a lot of similarity between the two. So here, what this is doing is nitpicking. It's nitpicking a subset of a already volatile environment. And so what we're looking for is more volatility in a more volatile industry group than the already volatile index, more volatile index of the Nasdaq. So it's what we're looking for here is a real clear indication that it's really risk on. And we're looking for this relative strength line over here, this blue one, to really outperform the S&P 500, the Nasdaq the Nasdaq Composite. So does that happen? Sure it does. So when we get periods like this where this blue line is clearly rising and that means the semiconductor industry group is outperforming an already highly performing index being the Nasdaq, that is really risk on. So we're not quite seeing that yet. There's a little bit of down. You can see there, even when this was rising, this was falling slightly. So what we're looking for is this outperformance in a higher volatility sector than the already high volatility index. So that might take a bit of a time, and really we'll keep an eye on this relative strength line over coming sessions. Onto the All Ordinaries. The All Ordinaries is underperforming. So during risk-off environments, you'll see and it's not that positive a time for equities. You will see the All Ordinaries index, the Australian index, outperform the S&P 500, like we saw back here in this period of time. When it's really risk on and equities come to the fore, the more volatile US indices will outperform the Australian index, and we've just started seeing that dip over here, which means the S&P 500. So this is a relative strength comparison between the S&P 500 and the All Ordinaries index. So we're already seeing that by this blue line dipping means that the S&P 500 is outperforming the Australian market. So we should see a little bit of catch up over here, but certainly just from a relative perspective, these downward channels, which the US indices have all broken out above, the Australian market's still some way away from that. So these are relative to the price action in the particular index. So these are not the same gradient as what are happening in the US indices. So relative to itself, it's kind of underperforming itself. It needs to break out above this channel and start taking on this resistance area over here. This resistance zone, by my loose definition, not a mechanical one, is more than 5 days below a support level. Sorry, I call it resistance. A support level that indicates that support hasn't held. So it's positive in that it's come back to this support, which then became resistance. And on today's data, that's not today's data, that's yesterday's data, we should see a breakout back into the range. This sideways moving here, and then the next task for the upside for the All Ordinaries is to break out of this downward channel and rise above this upper channel downward slanting channel line, upper channel line. So I've spoken through the positives of the bull market, if you like, the upside for these indices. The flip side is these charts, which are available to all our customers to download into their own instance of Beyond Charts, is to watch those support zones and to see if price action falls back into the channels they're broken out of. Obviously, the All Ordinaries got to break out of it first before we can do that. But certainly, this support zone here is of significance for the All Ordinaries. So the theme certainly is that it's very much back into risk on. People who are trading mechanically should have already been 100% invested in both markets, the US and the Australian market. And if you're not, then you haven't been following your rules and you didn't trust. So let's keep going on what we've got ahead of us. The Australian dollar is a huge, so with the weakness in the US dollar, the index, US Australian dollar has come right back, a huge up bar over here. It's bounced off, found support here in line with what's going on with all the other variables in the market that affect the Australian dollar. And it still hasn't given an entry signal. We got a mechanical entry signal here, a breakout line here based on the average true range breakout, but it is in the lower parts of this big longward downward channel over here. So on to now, just to move across to commodities. This weekly chart will be a couple of days out of date, but if I had to go and look at daily, you will see that the last couple of days, the CRB index has risen on the back of strength in the commodities that make it up, particularly oil. So it's what we're looking at in this weekly chart. So this is pretty long term. We've broken out of this downward channel, found some resistance here. We want to see a breakout above this resistance and into a new uptrend for the case to risk on to be on in commodities. So let's have a look at some of the commodities that we analyze. Gold has broken out of the first one, this downward channel here. I kept this gray channel, it's broken out of there. I've kept that gray. We'll remove this black one in probably the next analysis that I do, update that I do. But we've made a higher peak. We're now looking like another couple of days. If you're looking at a 3-day swing chart, you need another day or two for upward bars over here to be added to this data set to form another trough, in which case we've got a higher low as well. And that is a rise. That's a breakout above the channel lines, and it's above the support line over here, which became resistance. And that black line, that black resistance zone up there is the all-time high in gold, which was made way back there, another touch point there, another touch point over there. So that would be its fourth attempt to break out. Now, I don't believe that gold will break out unless we head into really negative, into a secular bear market, which is no evidence of at the moment. So gold will probably continue to range trade. Nothing to report on silver and on copper. Certainly still in this downtrend over here. There's the upward channel, needs to break out. Range trading now between these two support and resistance zones and underperforming equities. On Brent Crude, we did break down out of this pretty steep channel here, and that is a downtrend. A couple of up days over here, and will be adding to the weakness that we saw in the last week's red bar in the CRB index. And over here, down here, relative to the S&P 500, started underperforming the S&P 500, so into equities. So almost time, in fact, it is time to draw another one of these black downward channels over here and join those two peaks, which I'll do for the next session. Okay, this is one that was asked for, is the relative relationship between Bitcoin and gold. So what I have here in the top line is Bitcoin, and what I have in the top graph and the bottom graph here, I have the gold, the futures gold price. In the middle here, I have a relative strength comparison between the two, which is just a ratio. So you just divide the one by the other, and the main chart here being Bitcoin. So whenever this blue line is rising, Bitcoin is outperforming gold, and whenever it's falling like that, then Bitcoin is underperforming gold. So just to give your eye a little bit of training here, you can see here's a period where both Bitcoin is falling and gold is falling, and the blue line is falling, which means that although they're both declining, is that this blue line is telling us that Bitcoin, the relative decline was greater than the decline of gold. So I told you they were both going down, but Bitcoin is going down by more than what gold was. So this relative strength line is, if I'll just zoom out over here, because we've got meaningful data probably from around about here, is that you can see that the relative out or underperformance is quite volatile of Bitcoin and gold. But the question was the relationship. So first of all, there is a relationship. It's not exactly the same. If it is exactly the same, both from a direction and a volatility perspective, you'd have almost a straight blue line over here, which you don't have. So it's the first thing to show is that, by that I mean, for instance, if you put the S&P 500 over the SPY, which is the index ETF of the S&P 500, you'd have a virtually straight blue line going across. But you don't have that here. But the point is that I think was asked is, what about the direction? So, and it is a good question, because the direction, there is quite a close correlation between Bitcoin and gold. And what I've done here is I've just to make it easier for the trained eye to get a little bit of order around the price action, the relative price action, is wherever I've got black trend lines, and you can just look at the top chart over here, which is the Bitcoin chart, then the relative direction, not exactly the same, is, I would say, is quite correlated, not highly correlated, but correlated enough to say that there is a positive correlation between the direction of Bitcoin and gold. So let's just step back a bit over here, and I'll just zoom in so it's easier to see. Is that there's red, so that both. So wherever it's red, there's negative correlation. They're not going in the same direction. So there's red going in different directions. There's black, and I've kind of lined up the bars almost exactly, and it's never going to be exact, but it's maybe 1 or 2 bars out here and there. There's relative direction, the same, not the same, the same, the same, not the same, not the same, the same. Now, if you just had to go back to 2017, round about where I started doing this, lining these bars up, is that there are big moves in both going in the same direction that are big enough to, if you maybe brought in another indicator or something, or use some of your own subjective technical analysis to say that one indicates the other. But I'm not going to do that exercise now. So there is enough correlation there to form a concept, a basis of some kind of trading methodology. And I guess that's what the essence of the question was. So hopefully I've answered that. But of course, like everything, it's not an exact science, and you'd need to, if you did want to make it mechanical, I suspect you'd need to bring some other kind of confirming indicator in to assist with the correlation and make it a more mechanical thing. Right, just Detmar's just said a declining US dollar would generally be very bullish for commodities, which in turn should be quite bullish for ASX stocks. Is there any correlation between the CRB index and the SPX, negative or positive? That's one we'd need to look at. But again, that is subjective, and it's a theory, if you like. It's a theory of a potential concept. And my natural reaction to that, Dietmar, would be to go and do some research. I wouldn't say what I've done here as being enough research. It might be the first step of this relationship between Bitcoin and gold to say there is enough of a correlation to potentially be the basis of a concept that you could go and exploit with a mechanical trading system, which would require much more in-depth research. Is there, Robin's asking, is there an ETF on Bitcoin? There are, I think, in the US, but these things have only been around too short a period of time to really go. In fact, even Bitcoin, I would say, is only just reaching around about 10 years of reliable data, and even the early part of the 10 years would not have been reliable enough to really go and formulate a concept on that you could create a mechanical system out of. But certainly, and that would be the case with the ETF Bitcoin, an ETF on Bitcoin as well. Right, Ethereum has also broke. It's a bit of a following. It's just a bit of a lag on Bitcoin, but the Sirach indicator is basically saying that it's a risk-on environment for Ethereum, which it's also said on Bitcoin as well. Right, I think just a couple more charts to look at, and then we can take some questions on iron ore. The higher high, higher low at resistance, up 128. Fortescue and other stocks are certainly reacting to the iron ore situation. It's at resistance, would need to break above that, but certainly has broken out of this channel line that I had here, this gray one, and time to maybe do some more analysis on up and down channels. I could certainly put another upward channel over here. There's two distinct troughs here, and then we could do parallel lines to get the up channel now forming. On thermal coal, found resistance, has come back down to support. This support does need to hold on thermal coal for the upside case, and on the downside case, if it doesn't hold, then we could see more weakness in coal. And that is where I wanted to go with the analysis on commodities and on the indices. So back to indices, just to finish up and on a summary. This is certainly all mechanical traders on this breakout should have already been set in their positions, and so you should all be set. If you're mechanical trading using our mechanical trading systems, if you're using the shorter term one, SPA 3 Trader, then you would have waited for the low market risk entry signal before you started trading, so you might not be fully invested there, but certainly SPA 3 Investor, the medium to longer term mechanical system, should have been 100% invested from probably a couple of weeks ago and have got the full benefit of this bounce so far. So keep an eye on resistance levels and support levels going forward to see where we are, but certainly the theme is breakout to the upside, and this is the very bullish early green shoot environment that we're seeing here at the moment. Graham is just saying there are two new ETFs for Bitcoin and Ethereum, that the ETF provider is Global X. Right, no more questions or comments. We'll end it there. Thank you very much for your attention. Be back in a couple of weeks' time to see what the next saga and excitement the market has in store for us. Until then, I wish you consistent and peaceful and objective investing.